back for equity access. In this edition of our special focus, we look at Cafca, which is a manufacturing company listed on the Zimbabwe Stock Exchange. The core business of Cafca is the manufacturing and supply of copper cables and allied products used for transmission and distribution of electrical energy and information, primarily in Southern and Central Africa. Aggregately, the company manufactures 900 cable products. Besides the ZSE, Cafca is quoted on the JSE and the LSE and is part of CBI Electric African Cables, which in turn is owned by Runet Limited, South Africa. Cafca has a market capitalization of 7.37 million and last traded at a price of 22.45 cents. Cafca has been one of the few gems on the Zimbabwe Stock Exchange, and just last year the company won an award for best performing counter, having achieved a tremendous annual return of 78.6%, recorded as the 6th best overall top gain on the ZSE. The company has managed to grow its revenues at a constant average growth rate of 10% per annum for the past 6 years and generated 29.3 million in 2015, which was a gain of 24% on the previous year. The company doubled its profits in 5 years to 2.1 million in 2014, while volumes took a similar swing. 2015, however, was not really a good year for the counter, though it continued to trail its peers in PE terms. Moving forward to 2016, Cafca has reversed the trend and is now swimming with the rest. We are talking of reduced sales, declining margins, and a huge save for the bottom line. The company became the first to issue a profit warning in 2016 at an AGM on the 18th of February.
And at the end of January, volumes are down 25% year on year, sales are down 31% year on year, and profit is down 84% year on year.
A staggering 84% decline in profit year on year is not a small thing. What is the future for Cafca? To answer this, we look at the factors dampening the company's prospects as well as its outlook.
A lot of the factors are extraneous to Cafca and extraneous to Zimbabwe. So the copper price has dropped from 6.5 down to 4,400. The impact of that on our business is our barter deal, where 150 tons would have given us 900,000 in sales. That same 150 tons will give us 600,000 in sales. So until that copper price recovers, that particular factor will remain.
Depressed copper prices are a major dampener of overall sales, with the net effect of eroding 33% in sales value. The outlook for copper prices is, however, promising, though the forecasted recovery is steady and gradual. According to the World Bank, the average price of copper will grow steadily at 2% per annum until 2020. To Cafca, this means that over the next 4 years, sales will steadily earn 8% more from the appreciation in the commodities price, holding other factors constant. The South African rand is one of the major deterrents to recovery, as it is forecasted to close the year worse off against the dollar at 16.59 rands to $1. That is from a current 15.6. Softer rand makes exports to SA relatively expensive, wiping off the 10% NAV contribution that was previously recorded, as it becomes cumbersome to withstand competition. This also works against Cafca as imports become cheaper, making even its local sales more expensive, considering the absence of legislation to protect local industry, among other factors. The overall weak commodity prices globally successively impacts on the economies that are heavily reliant on mineral income negatively, and this bracket makes up most of Africa's economies. Regional markets for Cafca's cables, Malawi, Zambia and Mozambique, are affected by this predicament, hence curtailing the company's efforts to spare sales. In valuing Cafca, we used multiples after discounting management's own projection of a 25% decline in the bottom line, to arrive at a revenue value of 17.1 million and a bottom line of 1.13 million, which is 37% worse off the comparable 2015 outturn. From this profit level, we arrive at a forward PE of 6.5 times and an EBITDA which is even lower at 5 times, which are both below the industry's average of a combined 11 times. We therefore believe that there's an upside presently to Cafca for the long-term investor. We, however, take serious note of the fact that the company is undergoing a difficult period owing to extraneous factors that are mainly beyond Cafca's control, but the company remains a favorite on the ZSE owing to its monopolistic characteristic as well as its strong balance sheet. The copper recycling initiative with ZETDC goes a long way in countering margin loss, and management's focus should be on containing costs, and this requires streamlining of operations. This has been our special focus on Cafca. I'm Respect for Equity Access.